In every recession, millions of Americans lose jobs, drain savings, and panic, sell their investments. But the rich, they quietly get richer. In the 2008 crash, while fear wiped out trillions, the wealthy bought stocks, real estate, and businesses at discounts most people were too scared to touch. And that's exactly why recessions transfer wealth. Most people think recessions destroy money. The truth is far more brutal. Recessions often move money from the fearful to the prepared. But here's where it gets dangerous. The same downturn that ruins one family can create generational wealth for another. Tonight, you'll understand why, and more importantly, how to use the next recession like the rich do. Section 1. The problem. When recession headlines hit, the average American reacts emotionally. Layoff fears, inflation, debt, mortgage pressure, 401k balances dropping. So what do? They freeze spending, sell investments, hold cash, wait for things to feel safe again. Sounds smart, but this is exactly how wealth gets left behind. During the 2020 crash, the S&P 500 fell around 34% in just over a month. Millions panic sold near the bottom. But within months, markets rebounded violently. Those who sold locked in losses. Those who bought built wealth. Most people never realize this. Recession fear doesn't just hurt portfolios. It destroys decision-making. And the rich know this. Section 2. Why it happens. The wealthy don't love recessions because they enjoy chaos. They love what recessions do to prices. Assets go on sale. Stocks drop 20 to 40%. Real estate gets discounted. Businesses lose desperate owners. Private deals appear. Cash becomes power. The middle class sees risk. The rich see discounted future cash flow. That's the mindset gap. Imagine a stock earning strong profits trading at $100. Panic hits. Now it's $65. The business didn't change much. The price did. To the average person, it feels dangerous. To the wealthy, it feels like Black Friday. But the real reason is even worse. Most people are forced to survive the recession. The rich are positioned to exploit it. That difference changes everything. Section 3. Real. U.S. example with numbers. Let's use a realistic American example. Meet two families, the Millers and the Harrisons. Both families earn $120,000 per year. A recession hits. The Millers have $8,000 in credit card debt. 1 month emergency savings. 2 car loans, no extra cash, panic about layoffs. The market drops 30%. Their retirement account falls from $90,000 to $63,000. Fear takes over. They sell. They move to cash. Loss. Locked. Now, meet the Harrisons. Same income, different system. They have 12 months emergency savings, no consumer debt, $40,000 cash reserves, automatic monthly investing, access to low-interest credit. When the same 30% crash happens, they buy $20,000 into index funds, $10,000 into tech stocks, $10,000 reserved for real estate deals. 2 years later, markets recover 50 to 70% plus. That $20,000 alone can become $32,000 to $35,000. Their recession fear became wealth acceleration. Same economy, same salaries, completely different outcome. The real difference was preparation, not intelligence. Section 4. The system the rich use. So how do wealthy people prepare before recessions? Here's the exact framework. Step 1. Build cash before the storm. Cash creates opportunity. Rich people know downturns are temporary, so they stockpile liquidity. Your goal: build 6 to 12 months of expenses, plus an opportunity fund. Even $5,000 to $10,000 can change your next recession. Because when prices crash, cash buys confidence. Step 2. Buy strong assets, not hype. Not every dip is an opportunity. The wealthy buy. Broad index funds, profitable companies, cash-flowing real estate, undervalued businesses, not random meme stocks, not emotional gambles. The key is quality. Most people never realize this. Rich people don't buy cheap. They buy valuable assets temporarily mispriced by fear. Step 3. Use dollar cost averaging. Trying to predict the exact bottom is a losing game. Instead, buy in layers. Example, if you have $10,000, split it into 5 buys. $2,000 now, $2,000 if market drops 10%. $2,000 if it drops 20%. $2,000 next month. $2,000 next quarter. This removes emotion, and emotion is what recessions punish. Step 4. Protect income first. This is where most people fail. You can't invest in crashes if your paycheck disappears. So before buying assets, strengthen skills, diversify income, freelance, build side cash flow, cut fixed expenses. Income stability equals recession power. Section 5. Wealth Mindset Shift. Here's the lesson. Rich people understand recessions are not primarily financial events, they are psychological transfer events. Money moves from panic to patience, from weak systems to strong systems, from consumers to owners. That's why rich people don't ask, will the market crash? They ask, what will I be ready to buy when it does? That single question changes your financial future. Because wealth is rarely built in comfort. It's built in chaos, when everyone else is afraid, when headlines scream collapse, when assets become discounted. That's when fortunes quietly begin. And that's why rich people love recessions. Not because recessions are good, but because fear makes everything cheaper. So tell me in the comments, would you panic in a recession or buy more? I want to know how you would handle the next crash. And if you want more powerful finance psychology videos about wealth, investing, and escaping middle-class traps, subscribe now and join the channel. Because the next recession could either hurt you or change your life forever.